Okay, good evening and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today what we're going to do is we're going to focus our attention on a topic that for many investors, especially with options, tend to find a little confusing. So today what we're going to do is we're going to break down the basics of buying and selling options and making sure that we understand how you can apply them specifically with the Greeks and how they can be helpful in better understanding how call and put options respond to different factors in the market, whether it's a stock moving up or higher or lower, time value, or even changes in leverage. So those are the things we're going to explore here today. This is a education session more for those who have a basic understanding of options and perhaps has already traded some options. So also if you have any questions regarding Greeks, and I know many people who are in the process of learning how to trade options typically have a lot of questions with how delta, gamma, theta works. So if you have those questions, feel free to prepare those and ask them at the end. Today is really meant to be more of an interactive session. We're going to go over the basics. We're going to explain what the Greeks mean, but we want to give everyone the opportunity to ask your questions that you have with respect to how option Greeks work. So let's go ahead and get started here. Before I do, just a quick disclaimer, what we're going to discuss here today is purely for educational purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll spend quite a bit of time, but before we get started, I just want to make sure everyone has access to OptionsPlay, which is again free of charge to all all Nordic investors. You can register for free at this link on your screen right now, which I'll post into the chat window. This is available to everyone to access the tools that I'll be showing you here today, access the education, and making sure that you have different tools and reports that we send out every single week to help you leverage the things that you're going to learn and implement them in your portfolio. So if you haven't already signed up, again, it's free of charge. You can sign up using the link here on your screen at optionsplay.se. So we're going to go over quite a few things here today. First of all, in order to understand the Greeks, we need to do a quick review of the basic strategies. So we're going to talk about buying stocks versus options, what the primary difference is. And this is really why we need to study the Greeks, because when we look at the stock markets and look at stock trading, it's easy to calculate your potential risk and reward. When it comes to options, there are a lot more factors at play, and the Greeks help us understand what those factors are and how big of an impact they actually have on the value of the option that we're buying or selling versus it's easy to calculate the value of a stock because the price is published. And if the stock goes higher, you know exactly how much money you'd make. If it goes lower, you know exactly how much money you would lose. But with an option, if the stock goes up 5%, it difference if it goes up 5% in a week or 5% in a month, the value of your option will be different. So that's why we look at the Greeks to help us better understand the impact of different factors on our investments. And also, it's also useful in helping us choose which options we actually want to invest in. So there's many ways that we can utilize the Greeks. We're going to explore those things here today, but in order to do that, we're going to first get into the two basic bullish strategies, which is buying calls versus selling puts. I want to make sure everyone understands the difference between the two. Then we'll look at the two bearish strategies, which is buying puts versus selling calls. There are differences there. There are nuanced differences, so we want to make sure that everyone understands that before we look at that. And lastly, what we're going to do is we're going to explore these option Greeks so that you have a better understanding as to how they apply. And then lastly, what we're going to do is we're going to try to look at some strategies using OptionsPlay. Now, before I get started, I do have a quick question before we get started. How many of you, please at this point, bring up your chat window, which is at the bottom of your screen. And please type yes if you're brand new to options trading or if you're learning how to trade options. And please type no if you have experience trading options or if you've been trading for a while. Okay, so I see a pretty big mixture of yeses and nos. So for those of you that answered yes, meaning you're new to options trading, we're going to do a quick review of the basic strategies so that you have an understanding of how they work. And for those of you that have experienced options trading, I hope that this also illustrates to you some of the nuances between the bullish and bearish strategies. Many times we group all bullish strategies into the same camp, but when it comes to trading options, they are quite different from each other. So I want to make sure that everyone is familiar with the differences before we actually start trading these strategies in our portfolio. So first, what we're going to do is we're going to look at the market itself, the stock market itself, because when we look at stock trading, this is truly, or what we purely call, a bullish or bearish exposure. And why is stock trading a pure bullish and bearish exposure? It really comes down to the fact that if you buy a stock or short a stock, you have immediate gains if the direction is correct. Meaning, if you have a stock, let's say the stock's trading at 188 crowns right now, and you buy the stock, if the stock goes up even by a single cent, you will start making money on that trade. If it goes down by a single tick, you will start losing money on that trade. So this is what we call pure bullish or pure bearish exposure. They are also what we call symmetrical exposure, which means that if the stock goes up by 1 crown, you make 1 crown per share. If it goes down by 1 crown, you lose 1 crown per share. So it's really easy for investors to understand that if the stock's at 188 crowns and it goes up to 210, how much money would I make on my stock investment? It's very easy to calculate that. And it doesn't matter whether it takes a day to reach 210, a month to reach 210, or a year to reach 210. You make the same amount of money on that stock investment. Same thing with shorting a stock. If you short a stock at 188 crowns and you think it's going to go down to 160, it's very easy to calculate how much money you'll make from that investment if you short sold the stock. And also, it doesn't matter whether if it makes that move very quickly or it takes a very long time. As long as it gets to that 160 level, you will make the same amount of money. So that, I think, for most investors is easy to understand, and there's no time, there are no time horizons, and there are no neutral options, which means that if you think the stock is just going to stay where it is, or maybe you think it's going to go higher a little, but then go down a little, but then end up roughly at the same price where it currently trades, there's no option, there's no stock strategy that allows you to make money from that. So you have no neutral options, but you have a lot of, it's a lot of easy to calculate exposure. And I think most investors here on this call understand that. So if this makes sense to you, please type 1 into the chat window, because this is the fundamentals that we need to understand before we can start exploring options. Okay, so I see a lot of 1s here on the screen. So like I said, I think this is pretty straightforward. So let's now start taking a look at the options piece. Now, whenever you're trading options, there are 4 basic strategies. You can either buy a call, buy a put, or sell a call or sell a put. So those are your 4 basic strategies, or what normally we call long call, or long put, and then short call and short put. Because there's, for every contract, you can think of puts and calls as a contract. On every contract, there are 2 sides to the contract. You have a buyer and you have a seller. The buyers have certain rights and the sellers have certain obligations, but largely, basically, for whatever quadrant you find yourself in. So let's say you are buying the call. What you have is you have the right to buy a stock or ETF at any time before expiration at the agreed upon strike price. So every option contract, generally speaking, has 3 specifications. Which stock or ETF are we referring to? At what time does the option contract expire? And at what price, what agreed upon price can the buying and selling be completed at? And it's always the buyer who initiates the contract, or I'm sorry, it's always the buyer who initiates the exercise or the right to buy or the right to sell. Whoever's selling that option contract has the obligation to do whatever the buyer wants to do. The buyer has the right at any time to trigger his option, if you will, to buy the stock at a specific price anytime before expiration. Now, these 4 strategies, generally speaking, fall under 2 camps. There is either what we consider bullish strategies, which is generally speaking long call, or a short put. Those are the 2 bullish strategies. A long put is a bearish strategy, and a short call is also a bearish strategy. But if we think about bullish and bearish, this is really where sometimes I think it's a little misleading to call a long call a bullish strategy in the same camp as you would say a short put is a bullish strategy. From my perspective, both of these descriptions is actually not fully correct. And that's what we're here to explore today, is when you buy a call, what does it actually mean? When you sell a put, what does it actually mean? Because the 2 are actually quite different. And depending on what your outlook on the underlying stock is, you would choose different ones. There's really never a scenario where you're asking yourself, should I buy a call or should I sell a put? Because based on your outlook, you should be very clear as to which strategy is best suited for you. And same thing for bearish strategies. You should, based on your outlook on the underlying stock, you should have a very clear understanding as to what's better for you, buying that put or selling that call. Now, this is sometimes confusing. So one of the things that many investors do to help avoid some of the confusion, especially if you're brand new and you're thinking to yourself, how do I memorize these 4 strategies? The easy thing to do is to remember that calls are positive and buying is positive. That's an easy thing to remember. Puts are, whoops, this should be negative. Let's see. This should be negative, not positive. And shorting is negative, because I think that makes logical sense. Why buying and calls are positive, selling and puts are negative. And if you simply multiply them together, that's how you know whether you're getting a bullish or bearish strategy. If it's positive, then it's bullish. If it's negative, then it's bearish. So that's how we can remember the bullish and bearish strategies. But what we're going to do today is we're going to break down these 4 strategies and make sure you fully understand that. But before I move on, I just want to make sure everyone understands that these are the 4 basic option contracts. And it's so important that we learn these 4 basic option contracts, because in order to progress as an options trader, if you're looking to trade more complex strategies, and there are many ways to combine these 4 strategies together to give you specific payoffs, specific outlooks. And in order to utilize those and in order to understand those, it's important that we first understand these 4 fundamental building blocks. That's why we take the time to learn them. And once you understand these, the world is your oyster. You can really create all types of really complicated strategies as long as you understand these 4 fundamental basic strategies. So today, that's what we're going to explore. So please type 2 into the chat window if you're following along, and we're going to move on to the next slide. Okay, perfect. So we're going to start off by looking at buying calls. Now, we learned in that last slide that buying calls falls under the bullish category. So now, first of all, it's important to remember that when you're buying any type of option, whether it's a call or a put, both of these strategies are what we have limited risk with unlimited reward. What does that mean? That means that your potential reward on a long call or a put is unlimited. There's no limit as to how much money you can make, and you have a limited loss, so that there's always a maximum as to what you can lose when you buy a call or a put. That is the asymmetrical risk that many times investors are seeking when they're utilizing options, or is attractive about options, because when you buy a stock, you technically have unlimited risk, because if the stock goes to 0, you would lose everything that you paid for. Here with the call option, unlike buying a stock, whatever you pay for that call option, that's the most you can lose. So even if the stock goes to 0, you only have limited amounts of money that you can lose. And this is a really, without getting too far off track, but this is one of the great uses of options, is to use it as a risk management tool, so that if you get the direction of a view wrong, you have limited losses. But if you get the direction correct, you have unlimited gains to the upside. So as long as the stock keeps going in the direction you expect it to, you can make more and more money. But if, let's say, you're wrong on the direction, there's limited losses. And that type of asymmetrical risk profile is the type of risk profile that many investors seek. And that's why many investors look at options. However, when we're talking about buying a call option, normally we say that this is a bullish strategy. But from my perspective, just calling it bullish is not accurate enough. The correct understanding of a long call is that it's bullish by a certain amount. Now, what does bullish by a certain amount mean? In order to answer that question, let's take a look at this example. I have stock XYZ that's currently trading at 100 crowns. And I'm using 100 crowns as a round number to make it easy for us to understand the example. So in this particular case, I have stock XYZ. It's trading at 100 crowns. I think this stock is going to go higher. So what can I do? As a stock investor, I can buy the stock, right? I can buy the stock and the stock goes higher and make money. If the stock goes lower, I lose money. As an options investor, what I can do is I can buy a call option. So let's say I buy a 100 strike call option. I buy a 100 crown, I buy a 100 crown call option. And let's say this call option cost me 4 crowns. So it's a $100 stock. Normally, if I bought the stock, I would need 100 crowns per share. But when I buy a call option, I only need 4 crowns per share. Now, each option contract is for 100 shares. So to buy one contract, this would cost me 400 crowns. But to buy 100 shares of the stock, it would cost me 10,000 crowns. So here, here, instead of costing me 10,000 crowns, it only cost me 400 crowns. And my max risk, no matter what happens, is this 4 crowns that I pay per share. So even if the stock drops to 0, if I bought 100 shares of the stock, I would lose 10,000 crowns. If I bought this call option and the stock goes to 0, I only lose 400 crowns, 4% of the underlying stock value. Many options investors, when we think about buying a call option, we think about what percentage of the stock price are we paying for that call option, because that helps us get a sense for how much risk are we taking, right? So in this particular case, I'm risking 4% of the underlying stock price. No matter what happens, if the stock drops more than 4%, I'm better off buying a call option than I am buying that stock. 4% is not a big move to the downside, as you can see. Now, what is the downside to this, right? Why wouldn't everyone buy a call option instead of buying the stock? Well, who wouldn't want unlimited upside, just like a stock, but limited downside to just 4 crowns? And that's where the trade-off of options comes, because the trade-off that you're making here is the fact that if you buy a stock, 100 crown stock, even if the stock goes up by 1 tick, right? If it goes up to 100 and 101, I start making money on that trade. The trade-off that you're making here with this asymmetrical risk that you're getting with the option is the fact that the stock needs to move by a certain amount before you start making money. What is that amount? That amount is what you pay for the call option. What that means is that if the stock goes from 100 to 101, what happens is you actually have not overcome the cost of the trade. So what that means is that the stock actually has to go from 100 to 104 just for you to break even. So in this particular case, you can't just say, I'm bullish on stock XYZ, I think it's going to go higher, so I'm going to buy a call option. You have to say that I think the stock's going to go to 104 or more. So you have to actually believe the stock will be at 105, 106, 107. And remember, a call option has an expiration date. So you have to believe that the stock is going to make that big of a move before your expiration date. And that's not always easy to make that call to say, yes, it might be easy for you to say, I think the stock's going to go higher. Maybe a stock's trading near a support and you think it's going to rise. But it's much harder for you to say, I think the stock's going to be at 107 1 month from today or 2 months from today, because that's what you need to do when you're trading options. So that's the challenge when you're trading options, is that not only do you have to believe the stock is going to go higher, you have to believe the stock's going to go higher by at least the amount that you pay for that call option. And what you're going to discover is that depending on what stock you're looking at, some call options will cost you 4 crowns, some might cost you 6 crowns, some might cost you 3 crowns. So depending on the cost of that call option, that's how much the stock needs to move in order for it to make sense. So the more expensive your call option is, the more the stock needs to move before you can break even and start making profits. So that's why it's not just saying that I'm bullish on the stock. You have to look at how much does a call option cost, and then factor in, do I think the stock's going to move by that much and more, because that's what you're going to need in order to make sense for you to buy a call option. Because if the stock only moves, let's say 2 crowns higher, what happens? You actually lose money on the trade. And this is probably the most frustrating lesson for many beginner investors in options, is that you buy a call option for the first time, you get the direction correct, but the stock didn't move far enough and you lost money. And this is something that I see a lot from beginners, where they buy a call option, the stock goes in the direction they expect it to, but they lose money on the trade. And they ask themselves, how that doesn't make any sense. I bought a bullish strategy, but I lost money even though the stock went higher. And the reason is because it can't just go higher. It has to go higher by the amount that you pay for that call option. Does that make sense, everyone? Please type 3 into the chat window if this makes sense to you, because this is by far just the most difficult thing to learn about options trading. Once you learn this and overcome this learning curve, then all other strategies become a lot better, a lot easier to understand, okay? So your benefit of a call option is the fact that you can make a directional bet on an underlying stock. And if the stock keeps going higher and higher, you make more and more money. But if the stock doesn't go in the direction you expect it to, you're capped at just four crowns here, right? So that's a good trade-off. But the But the reality of it is that not only do you have to be bullish on the stock, you have to be bullish by the amount that you pay for that call option. So that's the first lesson that I think for many beginners needs to be learned. And even if you're an experienced options trader, I think this is a very important lesson to get a refresher on, because now we can think about buying versus selling, because the next strategy I'm going to teach you is selling puts. Now, this is not a beginner strategy. This is a strategy that is more important to learn from a conceptual perspective right now if you're a beginner. If you have experience options trading options, you'll get this pretty quickly. But whenever we're selling an option, this is when the risk to reward flips on a dime, right? So when you're selling an option, you get the exact opposite of someone who's buying an option. So before, we had limited risk, unlimited reward. Whenever you're selling an option, you have unlimited risk with limited reward. And many investors will say to themselves, why would I ever be in a situation where I want limited reward and take on unlimited risk for that? That doesn't sound like a great idea, right? So let's walk through why an option investor might want this type of risk profile. So I have the same stock XYZ trading at 100 crowns. Now, in this particular case, I think the stock is going to go higher, right? Whether I think it's going to go 1 crown higher, 10 crowns higher, 100 crowns higher, doesn't really matter. I just think it's going to go higher. So let's use that as an example to say, let's sell a put option. Now, a put option is also under the bullish camp, but to clarify, the best way that I define a selling a put option is not as a bullish strategy, but a strategy that's somewhat bullish, but not too much. Meaning, I think the stock's going to move a little bit higher, but not by too much. And I'll show you why. So let's say in this particular case, I have stock XYZ. I think it's going to go higher. So let's say I sell a 100 strike put. I sell the 100 strike put. And in this particular case, because I sold the contract, instead of buying before I paid 4 crowns for that call option. Here, because I sold the put, I get paid 4 crowns. So this is the key to understanding selling a put. Why would you ever want to do that? Because now by selling a put, my max risk is 96 crowns, meaning if the stock goes down to 0, I would lose 96 crowns, which is 100 crowns minus the 4 that I received on the selling the put. And the max reward I can possibly make on this trade is only 4 crowns. And a lot of investors will again ask, why would I ever want to take on 96 crowns worth of risk for just 4 crowns? And the answer is because this is a strategy that's very forgiving. Meaning, if the stock, which is at 100 crowns, moves higher, I keep my 4 crowns. It doesn't matter if the stock stays at 100 or goes to 101, 102, 105, 110, or 1,000. I always make 4 crowns. As long as it stays above the strike price that I sold, which is 100 crowns, as long as it stays above 100 crowns, I make 4 crowns. And what happens is that even if the stock goes a little bit lower, even if it goes to 99 or 98 or 97, I can actually still make a profit. This is what we call a very forgiving, high probability strategy, because you can even get the direction wrong and still make money on this trade. The only downside is that if the stock really makes a big move to the downside, right? Let's say the stock goes down to 90, then what I'm doing is I'm risking more. But for most investors who are utilizing this strategy, they're saying to themselves, there is an expiration date, right? What are the chances that if, let's say I'm selling a put on H&M, what are the chances that H&M will be bankrupt in the next 2 months? Chances of that are pretty low, right? Maybe there's a good chance that it might go down 10% or 15% in a big move to the downside because of earnings or something like that. But I'm fairly confident that the stock will maybe go down by no more than 10%. So in reality, 96 crowns of risk is only going to happen if the stock moves down to 0. In reality, you might say to yourself, even if the stock goes down to, let's say, 90 crowns, right? If that's the case, what I'm losing is only 6 crowns. So I have basically a relatively low chance of risking 6 crowns and a pretty high probability of making 4 crowns. So that risk to reward ratio, as you can see, looks much better, right? We're not really truly risking 96 crowns to make 4 crowns. What we're really risking is maybe 6 crowns, maybe 8 crowns to try to make 4 crowns. But as long as the stock stays where it is or moves higher, I can make money. So that's really the reason why someone wants to sell an option, is because they think the stock's not going to move a whole lot. They think it's going to move up a little bit, but even if they get the direction wrong, they can still make money on this trade. That's why you want to sell a put option. Now, does that make sense to everyone? Please type 4 into the chat window if that makes sense to you. But again, that's why we say that selling a put option, it's not a bullish strategy. It's a bullish, somewhat bullish, but not by too much. Now, why do I say it's not by too much? Because if I think the stock's going to go from 100 to, let's say, 110, or let's say 115, guess what? You're better off buying the call option. So that's why when I said before in the beginning that you're really never in a position where you should find yourself where you're going to say to yourself, I'm not sure whether I should buy a call or sell a put. The answer is, because you know how much you're going to collect in terms of credit when you sell a put, and you know exactly how much money you would pay if you bought a call option, you can lay the graph before. The graph looked like this, right? For the call option, the graph looked like that. Those are the two differences. The green is selling the put, the red is buying that call option. So basically you can ask yourself, do I think the stock's going to be at that point? Because at around that level, the two are basically equal. But anything, if I think it's going to go above that level, I'm better off buying a call option. I'll make more money while risking less. But if I think the stock's going to stay right here, maybe goes up to 100, 101, 102, then I'm better off selling the put, because if I bought a call option, I would actually lose money. So the power of using a tool like OptionsPlay, which I'll show you here in 1 minute, is that you can actually compare the two side by side and know exactly which one makes you the best profit based on the outlook that you have on the stock. But it's just important that you understand these are the two strategies that you have at your disposal using options to take a bullish view on the stock, and how you can compare the two side by side using OptionsPlay. So again, I think the best thing to do is actually look over here on OptionsPlay. And I'm going to use H&M here for a second. So this is the OptionsPlay tool. Many of you already have access to it. If you don't, we sent you that link here at the beginning to show you how to sign up. We'll show you that link again at the end if you don't have it just yet. But this tool allows you to explore option strategies and compare them side by side. So if I type in H&M, I can select either I'm bullish and look at 3 bullish strategies, or I can select I'm bearish and select 3 bearish strategies. Now, H&M certainly has been in a downtrend, but recently looks like it was starting to break up to the upside, started to break above some resistance levels. So maybe you think H&M is starting to turn around. You think H&M can maybe move to the upside. And depending on how far you think H&M is going to move to the upside, what you can use is this tool to compare buying, let's say, a September 140 call versus, let's say, selling a 140 put. So here, I can buy a September 140 call and pay $780 crowns, or I can sell a September 140 put and collect 570 crowns. So as you can see, those are the two strategies we looked at before, right? This is a call option. That's the payoff graph of a call option, and this is the payoff graph of a put option. And what you can do is you can use OptionsPlay's tools, our P&L simulator, to say, well, H&M, if it goes up to, let's say it reaches up to that next resistance level at 147. I think that's a pretty high probability trade of the stock moving up to that 147. As you can see, if I sold the put, I make 570 crowns. If I buy a call option, I actually lose 80 crowns. Again, this is the lesson that I think many beginner investors fail to learn at first, because they just learned that call options are bullish. So they think the stock's going to go from 141 to 147. Let me buy a call option. But what they don't realize is that it depends on how much money you pay for that call option. In this particular case, you're paying about 7.8 crowns for that call option, which means that H&M has to move up by 7.8 crowns for you to break even. So you have to believe it's going to move 10 crowns, 12 crowns, 15 crowns for it to make sense for you to buy that call option. In this particular case, if it goes from 141 to 147, that's only roughly 6 crowns. That's not enough to overcome the cost of that call option. This is the biggest challenge when it comes to buying any type of option, is that you have to overcome the cost of that option. And that's why many investors prefer then to sell a put option. Now, from my perspective, I think the most important thing for most investors when they first start off is not looking at how much money can you make, but look at how much money can you lose, because that's the only thing that you truly have control over, is understanding your position sizing, so that even if a really adverse move happens, even if the trade turns the exact opposite direction that you expected to, that doesn't cause you to blow up your whole account. So it's important that you understand, well, what happens if H&M revisits, let's say revisits that 120 low, which is put in back here in May. Let's say it goes back down to 120. Here, I'm losing 1,400 crowns. And you have to ask yourself, am I comfortable taking on that type of risk? If the answer is yes, then go ahead and place that trade. If the answer is no, then you should not be placing this trade to begin with. Maybe you're better off buying a call option because you're more comfortable with the 780 crown risk. So always look at your risk metrics first, then look at what are your potential upsides. How much money can I make if the stock really takes off? How much money can I make if the stock stays the same? And really understand these strategies so that you don't get surprised by it after you place the trade. I've seen too many scenarios where an investor buys a call option, not really fully understanding when they make money, how far the stock needs to move before they make money, and next thing they know, they're in the trade and they're not making the right or the P&L of the trade doesn't correspond to what they're expecting. So this tool lets you actually see how the trade will actually respond if the stock moves higher, if it moves lower, or if it stays the same. So use these types of tools to help you better understand these strategies, okay? So I can spend the time looking at buying puts and selling calls, but it's really just the exact same strategy that I just explained to you, a mirror image. So I'm just going to go through this very, very quickly so that we can jump to the option Greek. So buying a put option, same thing as buying a call option. Basically what you get is unlimited gains to the downside now. So if you think the stock's going to move lower, stock XYZ, you think it's going to move lower, you can buy a put option. So let's say I buy a 100 crown put and I pay 4 crowns for it. I have the same challenge as before. I have the same risk payoff where I have unlimited gains if the stock goes lower, but I have a max loss of just 4 crowns because that's how much I paid for the put option. Now, this is the risk profile that you get. You're risking 4 crowns to potentially make unlimited gains. Now, technically there is a limit because the stock can't go below 0, but if the stock goes to 0 here, I'm making 96 crowns per share versus only risking 4 crowns a share. Now, this risk profile for many investors is very attractive to be able to get unlimited gains with limited reward, but the challenge is the fact that because you paid 4 crowns for it, the stock needs to move at least 4 crowns just for you to break even, which means that you have to believe the stock's going to go to 95, 94, 93, 92 crowns before you actually make a real profit on that trade. And so you have to not only ask yourself, do I think stock XYZ is going to go lower, but do I think it's going to go down to 93, 92, 91, or even lower before the expiration date? So remember, there's an expiration date when it comes to trading options, and that is an important piece to also remember. And we're going to talk about that when we explain the Greeks. But buying a put, just basically the mirror image of buying a call option, but for when you have a bearish view on a stock. Does that make sense, everyone? Please type 5 into the chat window if buying a put option makes sense to you compared to buying a call option. And Kristen, I see your question. I will address that at the very end. So lastly, we'll talk about selling calls, which again is very similar to selling puts, but just a mirror image of it, so that if you think the stock's going to move lower, but not by too much, you think it's going to move lower a little bit, you can sell a call option. And this the only difference between selling a call option and selling a put option is that selling a call truly has unlimited risk because there's no limit as to how far the stock can move higher. There is a limit as to how far the stock can move lower. So when you sell a call option, this truly has unlimited risk. And in exchange for that, you have limited reward. So if you have stock XYZ trading at 100 crowns, you think the stock's going to move, you think it's going to move lower a little bit, then what you can do is you can sell a call option, a 100 crown call option, and let's say you collect 4 crowns for that call option. What you have is unlimited risk in exchange for just 4 crowns in potential rewards. And this makes sense if you think the stock's going to stay the same, move a little bit lower, or even if it moves a little bit higher, you're still going to make money. The only time you lose money is if the stock makes a big move to the downside. That's when you lose money on selling a call option. Now, again, depending on how far you think the stock can go, because if you think the stock can move down substantially, what you're much better off doing is actually buying that put option, because if the stock moves down substantially, you have the same amount of, you have actually a smaller amount of risk with a much better risk to reward ratio. So that's how you choose between, should I buy a put or should I sell a call? It really just depends on how big do you think the move is actually going to be. And based on that, it should be pretty clear to you which one you want to do for your portfolio. Now, this doesn't get into, you know, the mechanics of, or the actual, I would say, strategies around trading. We haven't covered that yet. This is meant to just give you a basic understanding of the strategies, because once you understand these basics, then we can start getting into strategy. We can start thinking about, when does it ever make sense to sell a call option? Does it ever make sense to sell a call option? Or are you better off doing something else? But in order to even explore those concepts, we need to first understand these fundamentals. That's why it's so important that we understand this. So if this makes sense to you, please type 6 into the chat window. And that's not something that we have enough time today to explore, but these are the fundamental building blocks that are required to even start thinking about, does it ever make sense to sell call options? And if it does, when do you do it? Does it ever make sense to buy a put? And when do you do it? So first we have to understand this, and it sounds like all of you are following along, which is great. And that allows us to get into our next topic. So next, what I want to do is explore the option Greeks, because right now we talked about everything from a very theoretical perspective, right? Stock XYZ trading at $100. We think the stock is going to go, let's say we have a 100 crown stock. Here's the thing, is that if the stock goes from 100 to, let's say, 110, when you're trading a stock, that means that you're going to get 10 crowns in profits. When you're trading an option, it depends how much you'll make when the stock goes from 100 to 110. It depends on quite a few things. It depends on which option did you buy. Did you buy a 100 strike call option? Did you buy a 110 call option? A 90 strike call option? So it depends on which option you buy. So that's one of the things we're going to explore. The second thing that it determines is whether it takes a day to reach 110, or a week to reach 110, or a month to reach 110, because you think the stock's going to go to 110, but depending on if it takes a week or a month, the value of your option is going to be different if it takes a week to get there versus a month to get there. So those are the things that we're going to explore. And lastly, what we'll talk a little bit about is the change in leverage, because we typically are looking at options because we're looking for leverage. And it's important that you understand how that leverage actually changes as the stock moves higher or lower. So, you know, we talked about this asymmetrical risk, the ability to have unlimited gains if you buy a call or a put with limited losses. How does that actually happen? How do you actually achieve that? So these are the things we're going to explore, and the Greeks will help us better understand that. So the first one we're going to look at is understanding the impact of the directional move that the stock has. Meaning, if the stock is trading at 100 and the stock goes from 100 to 110, how do we calculate what our call option, or whatever option that we purchased or sold, how does the value of that call option change when the stock goes from 100 to 110? So what you're going to see is that for every option that you buy or sell, whether it's a call or a put, there's going to be a delta assigned to that call or put. Now, most brokerage firms will calculate this for you. If you don't have a brokerage firm that calculates this for you, I do recommend that you consider looking for a brokerage firm that might support that. There are plenty of brokerage firms that do, or ask your brokerage firm what tools they have to help you do this as well, because it's useful in helping you select your strike prices. So whenever you're buying a call option, generally speaking, if the stock's trading at 100 and you pick an at-the-money call option, meaning a strike price that's the same as the current price of the stock, so if the stock's at 100 and you choose a 100 call or a 100 put, the delta of that call or put is generally going to be 0.5. And the function of delta is always going to go from 0 to 1. So the delta of any option will always be either 0 to 1 for a call, or 0 to -1 for a put. So Call options will always go from 0 to 1. Put options will always go from 0 to -1, because puts are basically opposites of calls. That's why puts have a negative delta, generally speaking. Now, what delta tells us is how much money how much does the value of the call or put option change with respect to a change in the underlying stock's value, because the value of an option is predominantly derived from the value of the underlying stock. So whenever we buy an at-the-money call option, the delta of a call or put is generally going to be 0.5. And what that means is that, let's say I have H&M, and I'm going to use a real example. H&M stock's currently trading around 140 crowns. So let's say I buy a call option. I buy the 140 crown stock call option, and the stock goes from 140 to 145. So the underlying stock itself gained 3.5%. When it goes from 140 to 145, that's a 3.5% gain on the underlying stock. What I want to know is how much money do I make on my call option? So let's say I buy that 2-month call option because I think H&M is going to go higher. So if it goes from 100 to 145, what that means is that, let's say I buy the 140 crowns call option, and let's say that call option costs me 10 crowns. The delta tells me how much money I would make from the underlying stock if the stock moved up 5 crowns, because all I have to do is take the 5 crown move. So from 140 to 145, that's 5 crowns. I multiply that by the delta, which is 0.5. And that gives me my total return on the option, which is 2.5 crowns. So what that means is that if I paid 10 crowns for this call option, if the stock moves that 3.5% higher, what that translates into is the new value of my call option will be 12.5 crowns, which is a 25% gain on my option, while the stock gained 3.5%. So this is the leverage factor that many investors are seeking when they're trading options, is they want to say, if I get the move correct, I want the leverage, but if I get it wrong, I'm only risking 10 crowns, which in this particular case is about 7% of the underlying stock price. So no matter what happens, even if H&M goes down to 0, I'm only risking 7% of the underlying stock price. But if I get the direction correct, I'm leveraged my capital, because instead of making a 3.5% return on the stock, I can make a 25% return on the option. Does that make sense to everyone? What delta measures and how we can utilize this? So please type 7 into the chat window if this makes sense to you. Now, one thing I will point out here, what I'm teaching you today is a concept. You don't have to do the math yourself, because platforms like OptionsPlay do this math for you. So when I showed you before, when I use the slider, when things, when the option goes higher or lower, and how the value of the call option changes and the profit and the losses is calculated for you, what we're doing is we're actually taking the delta of the option, and we're calculating for you, if the stock goes up by a certain amount, how much does the value of the option change, and what is that in terms of percentages for your investment. So you don't have to actually do the calculations yourself. You just have to understand this from a conceptual perspective, that when the stock moves by a certain amount, the option will move by a ratio of that, and delta helps you calculate what that ratio is, and that's how we actually calculate if the stock goes up by a certain amount, how much money you make, how much money do you lose. That's how we're doing this. Now, the one thing to remember here is, in this example that I gave you, when the stock goes up by 5 crowns, the option will move up by 2.5 crowns. That is assuming that all other things are held constant, meaning time is constant, that everything else is constant, basically meaning the stock jumps from 140 to 145 instantaneously. So this is assuming that nothing else is in play. But reality is that that doesn't happen, right? Stocks don't just move from 140 to 145 instantly. It might take maybe a few hours, so it could happen very quickly, but it still takes time for that to happen. And it could take weeks for that to happen. So it's really important that we also learn not just how the underlying stock moving up or down affects the value of the option, but which is by far the most important factor. So when we think about the Greeks, right? For those of you that have already learned some of the Greeks, you might know that some Greeks are more important than others. By far, delta is the most important Greek, because it's the Greek that has the most impact to the changes in your option. Because if you buy something for 10 crowns, what you're mostly interested in is what moves this significantly lower or significantly higher. And the answer to that question is delta. Delta is by far the biggest impact on the value of your option. Now, the second most important factor to look at now is time. Because in the example here before, we talked about when the stock goes from 140 to 145, I was assuming that if everything else held constant, meaning if this move happened instantaneously, that my value of my call option will jump by 2.5 crowns. But in reality is that it takes time. It might take maybe a week for the stock to go from 140 to 145. So now what we have to do is we have to add a second Greek to the equation, and that's theta. Theta tells us the change in the option price with respect to time. So in the same example here before, let's say I think the stock's going to go from 140, I think it's going to go higher. So I buy a 2-month 140 crown call option, and I pay 10 crowns for that call option. And let's say the stock goes from 140 to 145, right? Exactly the same as we did before, but it takes 1 week to get there. So instead of just making the move instantaneously, it takes 1 week to get there. Actually, this is a typo. This should say 3.5% gain. So the stock moves at 3.5% higher in 1 week. So what we have to do is we have to add 2 pieces to the equation. Number one, we have to calculate delta, which is what we did before. So it goes from 10 crowns to 12.5 crowns. And now what we have to factor into is time, because the value of your call option will decay, will actually decrease in value as you approach expiration, because the less time there is for the buyer to exercise their call option, the less time value there's left in the call option. So theta measures for us the pace at which the value of the option will decay with respect to time. So if let's say we buy this call option and the theta shows us it's 0.06, what that's telling us is that for every day I hold on to this call option, it's going to lose 0.06 crowns per day. So let's say this move from 140 to 145 takes 1 week to happen. That's 7 days. What this allows me to do is say that for the 7 days that I hold on to it, I lose roughly 0.06 crowns per day. So my total loss on this particular trade is 0.42 crowns in terms of time value. So that's where I subtract 0.42 from the 12.5 crowns that my new value of my new option is worth, because the stock is now 5 crowns higher. I subtract the 0.42 crowns, and now that's how I know that roughly if the stock takes a week to go from 140 to 145 with everything else held constant, I'm going to be looking at about an option that's worth 12.08 crowns rather than 12.5 crowns. So now my gain goes from 25% to 20.8%. So still substantially higher than the 3.5% that I would have gotten if I just bought the stock. But as you can see, the longer it takes for the stock to reach that time or reach the target profit, the more I lose in terms of value. And that's why when you use this P&L simulator, so in the example before, I said that if it moves from 140 to 147, let's say it happened instantaneously. So the stock goes from 141 to 147 instantaneously without any time. The call option will give me a 34% return, right? So 141 to 147 is roughly 6 crowns. 6 divided by 141 is a 4% return on the underlying stock. So if you bought the stock, you're looking at about a 4% return. If you bought the call option, you're looking at a 34% return, because call options give you leverage, right? That's the leverage factor that you're getting. But if it takes a week to get there, so today is the 4th. So if it takes 1 week to get there, I'm sorry, today is the 5th. So if it takes 1 week to get there on August 12th, as you can see, instead of making 34%, you're looking at about 28%. So you've lost a little bit of time. You've lost a bit of the value of that option to time value. And the further longer it takes for this stock to reach that 147 target price, the more the value of your option is going to decay. And at some point here by September, right, this is a September 18th expiration. By September 9th, what happens is the amount of time value that you've lost overcomes the amount that you've made to delta. So delta and theta are the 2 most important factors to remember. Delta is if the stock goes higher or lower. Theta is the amount of time. So this is really the two most important factors to learn when you're trading options as to how the value of your option is changed. And our P&L simulator allows you to change each one of these factors and see how they change the price of your option. And then you can also use this time slider to see how theta changes the value of your option. Does that make sense, everyone? Please type 8 into the chat window if theta makes sense to you. And lastly, we're gonna look at gamma. So this is the one that I think it's not the most important one to learn. So if you struggle with this at first, it's completely understandable because gamma is the change in delta. And the reason that this is important is because delta is not static. And delta is not static because delta is what allows us, the change in delta is what allows us to actually have this asymmetrical risk profile, which looks like this. An asymmetrical risk profile looks like this, where as the stock goes lower and lower against us, we have flat risk so that the stock we don't lose any more money. But as the trade goes in our favor, we make more and more money. That's how we get the trade-off graph as we saw before that looks like this, right? And the only reason we're able to get that trade-off graph is due to gamma. Gamma is the change in delta with respect to the change in the underlying stock price. You know, we said before, when you start off with an at-the-money call option, you're always at about a 50 delta, meaning you're always around here, 50 deltas. And what delta is actually measuring is the slope of this curve. So for those of you that are, and I do recommend this, for those of you that are mathematically inclined, some of you are engineers, some of you have a basic understanding of calculus, or maybe you've learned some basic calculus and you learn about derivatives. Derivatives is really just a calculation of the slope of a curve. And I remember being in calculus class in high school asking myself, when the hell am I ever going to learn, when the hell am I ever going to need to calculate the slope of a curve? And this is a real life application of why you want to calculate the slope of a curve. A delta just tells us the slope of the curve. And as you can see, as we go higher and higher, the slope of that curve changes. And as the stock goes lower and lower, the slope of that curve goes closer to zero. So basically, as the trade goes against us, delta approaches zero. That's why we said a call option, delta ranges from 0 to 1, because as you get further and further in the money, the delta gets higher and higher and the slope of that turns into 1. As you get lower and lower, the delta of that turns into 0. Now, how does that change? That's gamma. Gamma tells us how the slope of that curve changes as the trade goes in our favor and as the trade goes against us. And gamma really helps us as option buyers, because what it does is it increases delta when the trade goes in our favor, and it decreases delta when the trade goes against us. So that's how we're able to get to a point where as the trade keeps going further and further against us, delta doesn't really have much of an impact and doesn't increase our losses any further. But as the trade goes in our favor, it keeps delta at 1, so it keeps getting higher and higher and higher, and that's why we get that slope to the upside when the trade is going in our favor, and it gets the slope down to a flat line if it goes against us. So gamma tells us the changes in the delta as the trade goes in our favor. So if you see an option goes from if you see the gamma of an option has a 0.02, what that's telling you is that for every $1 crown change in the underlying stock, it will change delta by 0.02. So in this particular example, if I have H&M that's trading at 140 crowns, and we think the stock's going to go up or down by, whoops, this should really say 3 crowns. Let's say it goes up or down by 3 crowns. What happens is that delta isn't constant, right? So before we said that if the delta is at 0.5, then if the stock goes up by 5 crowns, I make 2.5 crowns. The real calculation, and this is where gamma comes into play, is that you actually make a little bit more than 2.5 crowns. And if the stock goes down by 5 crowns, you actually lose a little less than 2.5 crowns. It all comes down to gamma, because as the trade goes in your favor, so let's say I buy the 140 call option, which starts off with a 50 delta. If the stock goes up by 3 crowns, it actually increases my delta from 0.5 to 0.56. So what happens is that I actually get more for every crown the stock goes higher. So if it goes from 140 to 141, 140 to 141, I make maybe 0.5 delta, but from 141 to 142, I make 0.52 delta. From 142 to 143, I make 0.54 delta. So basically, as the stock keeps going in the direction I expect it to, I actually make more per dollar or per crown on my option if the stock goes in my favor. And vice versa if the stock goes against me. So if it goes from 140 to 139, I lose, let's say, instead of 50 crowns, I might lose only 48 crowns. And then as it goes from 139 to 138, so the trade is going against me, right? Instead of losing another 50 crowns, I'm only risking, let's say, 48 crowns or 46 crowns. And the further it goes against me, the lower I'm actually losing per crown that the stock moves lower. And that's really where gamma comes into play. Like I said, this is the, I would say, an important piece to learn from a conceptual perspective. I never expect investors to learn how to calculate this. And this is really, I would say, one of the more difficult ones to learn with respect to option Greeks. But it is an important one because it is really what gives us the asymmetrical risk. Without gamma, we wouldn't have the asymmetrical risk because we need to change delta in order to get that curve looking like that. In order to get that hockey stick shape of that curve, we need gamma because gamma increases delta as the trade goes in our favor and decreases delta as it goes against us. So like I said, this is not one that I necessarily expect everyone, especially for those of you that are new to options, to understand. But if you do understand this, please type 9 into the chat window. And for those of you that do want to learn more, I do recommend you could go on YouTube, look at some videos on the basic or introduction to calculus or derivatives, and just look at, calculating the slope of a curve, because that's really what we're doing here when we're looking at delta. And gamma is the second order derivative. So gamma is the curve, is the slope of delta. So delta is the slope of this, this line, which tells us how the value of an option changes, and gamma is the derivative of delta. So I know I got into a lot of what I would consider some confusing topics for many investors if you're a beginner, but again, this is one of the most important fundamental building blocks that all other options, I would say, understanding is built off of. If you can understand everything that I explained here in this one session, you are way better off in understanding how to deploy these strategies for your portfolio and understanding more complex strategies and when you should buy a call versus sell a put, when you should trade debit spreads versus credit spreads. It all is based on the fundamentals that you learn here on this one webinar. So it's so important that I think people learn how to utilize this to better understand how to trade options. And you can always use OptionsPlay in conjunction with the education that we provide here to better understand these strategies and then give you the tools to actually allow you to set them up and compare them side by side and explore and analyze and learn before you actually go and execute your first trade. So with that, that covers what I wanted to share with you here today. I know I went a little bit over time, but I did want to make sure that I covered these strategies in depth so that you have a better understanding as to how to leverage them for your portfolio. So with this, what I'll do is I'll open this up for Q&A. If anyone has any questions regarding deltas, gammas, or just options in general, feel free to type them into the chat window. And while you type them in, I will scroll up and see some of the questions that came in during the session, and I will answer those first. So thank you so much for taking the time out here this evening. So Christian asked, there's also the option to purchase an option with a lower strike price. So even if the stock goes down, you still get the shares. So Christian, that is correct. You can buy an in-the-money call option. So whenever you're buying a call option, you have the choice of a lot of different strike prices. The lower the strike price, the higher the delta. The higher the strike price, the lower the delta. So you're absolutely right. You have a very wide range of choices. But for those of you that are, again, this webinar was not to talk about which ones, which strikes to choose or even what strategies to choose. This was just to understand the fundamental building blocks, because you have to understand the fundamental building blocks before we can get into strategies, picking strike price and expiration dates and all that stuff. But you're absolutely right, Christian. Let's see. Jan is saying, but the curvature of the option price gets steeper, so it should be more than 25%. So you're absolutely right, Jan. So in reality, in the reality is that in this example where I said that when it goes from 10 crowns to 12.5 crowns, as Jan said, exactly, delta actually increases. So it's actually a little bit more than 12.5. It's probably closer to 12.75 because of gamma, because gamma will increase delta. We're not just constant at 0.5. As it goes from 140 to 141 to 142, 143, 144, and 145, each step, delta is getting increased. So in reality, you're absolutely right. This is closer to 12.7 or maybe even 12.9, somewhere in this range, because not only are we making money from delta, we're also making money from gamma. So Jan, clearly you have a better understanding of option Greeks than I would say most beginners, and you're absolutely correct. Mike is asking about Vega. So Vega is an important concept, but the reason that I don't really get into Vega so much is because Vega is the one thing that none of us as options traders have any control over. Meaning we have control over where we think the stock's gonna go, or I'm sorry, we have a visibility or a view into where we think the stock's gonna go, how long it's going to take. So that's how we can calculate delta, theta, gamma. But Vega is the change in the option price with respect to the change in volatility. Now, the thing about the implied volatility is that it's something that most of us don't really have a forecasting to. It's not something that we really have any ability to impact, nor does it really have a large impact on the value of an option. So that's a last piece here at the downside. So we talked about these two so far, delta and theta, right? And really in this delta slider, gamma is actually included in that, because as the stock goes in your favor, it increases delta. So delta and gamma is actually included in this price slider. Theta is included in the time slider. And lastly, Vega is included in this volatility slider. So as the implied volatility of an option either increases or decreases, that also has an impact on the value of your option. So Mika, you're absolutely correct. The only reason that I kind of stayed away from this today is because implied volatility is a whole nother concept that we haven't really had a chance to explore yet. And I want to explore that first before we talk about Vega. But you're absolutely right, Vega is important here. Are you going to have a session about spreads? Yes, we will have sessions about spreads. We cover debit spreads, credit spreads. We will also cover time spreads coming up. But again, spreads, in order to understand spreads, you have to first understand these four fundamental building blocks. Once you understand these four fundamental building blocks, you can create all kinds of spreads. So we will have a learning session on spreads, and the debit, credit, and time spreads are meant to give you I would say, an introduction to how spreads are constructed, but in reality, you can construct them any way you want. But once you learn debit, credit, and time spreads, that really opens up, your creativity in creating your own spreads. Jan is saying, it seems like trading costs and spreads of buying and selling will have a huge impact. I guess, yes, it was just the gamma adjustment. Yeah, so yes, the gamma adjustment is correct. Trading cost is something that I think many investors are very sensitive to. I will say that, there are lower cost providers in terms of transaction costs. So you can look at those, for example, Interactive Brokers is one of the more price sensitive brokerage firms that you can take a look at. And I know for a fact that they're an international broker that accepts international accounts, and they offer global equities and options trading. So it really allows you to access world markets, and their trading costs are fairly low. They usually don't charge a commission, they only charge per contract, which is, for many investors that are trading one or two contracts, a much better model rather than paying 100 crowns per contract on a trade. Mika is saying IB is the cheapest one with excellent tool. So yeah, I know a lot of investors that trade at Interactive Brokers purely for the lower transaction costs. Can OptionsPlay have a portfolio manager to see how my positions develop? That is something that we are working on. I don't know that that's something we're going to be able to provide free to all Nordic investors. That is something that we are currently in the process of exploring and understanding how we can develop those types of tools for Nordic investors. But at the moment, that is not something that's available for Nordic options, at least not for free through the NASDAQ partnership that we have. Any other questions regarding delta, gamma, calls, puts, options in general? So Jen said, Nordnet seems a bit wide on spread cost, am I right? So Jen, your brokerage firm has nothing to do with the spreads. The spreads are the same for regardless of who you trade with. The only thing your brokerage firm controls is the commission that you're charged on top of the spread. So when I look at this H&M spread and it's trading at 690 by 780, no matter what brokerage firm you're at, you're going to see the exact same spreads because that's the best bid ask quote on the whole exchange. So your brokerage firm does not control the spread. So no matter what brokerage firm you trade at, the same spreads apply. Your brokerage firm will apply a fee on top of that. That is the thing that you have control over. So if you trade at a lower cost brokerage firm, you will see that the fees on top of the spreads are significantly lower. But let's say you have a 690 by 780 call and you want to buy it. The midpoint's at 730. What you should do is you should place your limit orders at, let's say, 735 as a starting point. You don't want to pay the advertised price. Think of 690 as 780 as the advertised price, the list price. But markets allow you to negotiate. That's the whole point of a limit order. The limit order is effectively you saying, I don't want to pay the advertised price. Here's what I'm willing to pay. Is there anyone out there who's willing to transact with me at that price? So when you put a limit order at 735, what you're basically telling the market is saying, I'm willing to buy at 735. Is there anyone out there willing to sell to me at 735? And what you will find many times is that when you place that limit order, you might find someone will say, I'll take that. I will sell it to you at 735. So that's how markets work. So, you know, many times you might see spreads are really wide. Think of that as just an advertised price. There's nothing stopping you from saying, I don't want to pay that. I want to pay this. Who's out there who wants to interact with me at this price? So keep that in mind when you're placing your limit orders. I almost always place my limit orders at the mid price or just a little bit above the mid price if I'm buying, a little bit below if I'm selling, just to see if there's anyone out there willing to interact. And many times that's what a market maker will do is you put that price at 735, someone will say, okay, I'll sell to you for 735. Market makers don't really have the incentive to quote really tight prices. They'll usually always advertise out here because sometimes someone's, you know, who really needs to get out will just say, okay, I'll pay the advertised price. But if you're not in that scenario, if you're saying, you know, I'll take this if I can, place that limit order. See if the market was willing to interact with you. Any other questions? I mean, these are some fantastic questions that I'm getting, and I hope that even just by answering these questions, you guys are getting some value out of this because this is something that we don't talk about a whole lot, especially educators. You know, we spend a lot of our times talking about calls and puts and mechanics. We don't really talk about how we enter orders as traders. So this is, I guess, I hope this is helpful in helping you guys better understand how a trader like myself would enter my orders and enter my trades rather than just paying the advertised price. So no matter how big that spread is, I'm only paying, let's say, 0.05 above the mid price. And that's really the only thing that matters is how much you're paying above the mid price, not what the bid ask quotes are. Any other questions? Mikkel and Jan, you're very, very welcome. Again, I really hope that this was useful in helping you guys better understand a little bit about the basic fundamental building blocks of options, giving you a brief introduction to option Greeks. Like I said, Greeks are just important to understand from a concept perspective. You don't need to know how to calculate them because platforms like OptionsPlay do the work for you. So play around with the platform. It does the work for you, gives you a better understanding as to what you're trading, and also more importantly, gives you an understanding as to if you buy this call option, what can you expect? A lot of investors buy a call option not really knowing what to expect. So when the stock goes up 10 points, you know, what the option is worth, they're kind of just realizing at that point. You should figure that stuff out before you place that trade. So when the stock moves up 10%, you know exactly how much money the value of your option should be worth so that you're not surprised by the amount of profit or loss that you have. Wolfgang is saying, my broker has weekly options. Should they be traded in the same way as longer time options? So weekly options just gives you flexibility in terms of timing. But from a trading perspective, they are exactly the same as monthly options. They obviously just expire in a shorter amount of time. But weekly options many times are great for selling. So if you're selling credit spreads, if you're selling covered calls, if you're selling cash secured puts, those are the best. Weekly options are great because it gives you a lot of flexibility to fine tune the expiration date that you're looking for. But yes, from a trading perspective, should be the same. Any other questions? This webinar is recorded, so what we will do after we finish here today is we'll send you the email with the link to the recording. I will also send you my slides so that you can follow along at your own pace with the recording. And you can always send us an email at any one point. So when you're on the OptionsPlay platform, there's this Ask Us questions at the top of the page. You can always type in a question and we'll respond to you by email within 24 hours. So you can ask us questions about trading options. You can ask us about the platform. This is always a great way for you to continue to reach us for any questions you come across as you're using the platform, as you're looking at strategies. You can ask us. There's no limit as to how often you can ask us questions. So please make sure that you use this tool and help get your option questions answered. So with that, thank you so much. I'm really glad to be back and doing these sessions again and making sure that you guys have access to continuing education to help you better understand options. I hope that you guys are able to utilize the tools itself to help you analyze and execute these strategies. And I hope that you guys are taking advantage of those emails that we're sending you on Monday, Wednesdays, and Fridays with the market reports as far as what we're currently seeing in terms of from a macro picture, how the OMX S30 is doing, as well as the trade ideas and the weekly cover calls and short put reports that we send you to help you execute these types of strategies for your portfolio. So make sure you take advantage of this. This is available to you free of charge. Not many places in the world offer this, and the partnership that we have with NASDAQ is fantastic in helping you leverage that. So take advantage of it, and please, if you have any questions, feel free to shoot us that email. Thank you so much. I hope you guys have a great evening, and I'll see you guys back here in a couple of weeks for our next education session. Have a great night.